Oh, heck yeah, we are certainly proper ready for earnings season kickoff, right? I was only a little bit tardy to the party today, but work gets in the way. But couldn't have missed these earnings because I was very much anticipating them from Pepsi. Well, really, Pepsico, if you want to think of it that way. I just call them Pepsi. But at one point, the stock was up around 3% today. Finished right around only 0.3% up as the market kind of took a little bit of a downturn towards the end of the day. So let's divest these earnings here. So again, my estimation when we did this earnings reports to watch, they were expecting a decline in revenue around 6%. I expected a beat on that aspect, and I did not give really an EPS estimate because it's kind of hard to say with current times. I will say, what they did? They beat on a non-GAAP EPS standpoint by 7 cents, and a GAAP EPS missed by 5 cents. Now, the revenue, they beat by $480 million, but still posted a 30% decrease year over year. And I got to be honest, I did expect a very small increase actually year over year, so I was incorrect in that aspect, but definitely still a beat regardless. So I am glad that they beat on that aspect because they were expecting, I think, a down 6 or 7% year over year number. I definitely knew that was not necessarily going to be the case. Organic revenue did actually decrease 0.3% year over year compared to a consensus of 2.8% down. So not good to see that because you think organic growth is really kind of what they're after. Just being frankly honest, it really is. The goal is really organic growth for a lot of these beverage companies because they think it's the future really of drinks. Now again, normal soft drinks will be there for a while. But revenue by segment, we'll certainly look at that here with the charts shortly. So total core operating margin rate was down 195 basis points to 15.8%. Not a shocker with everything going on as far as safety protocols. For the guidance for fiscal year 2020, they are expecting a tax rate around 21%, paying $5.5 billion in dividends, and repurchasing around $2 billion worth of shares. So again, this was Q2 of this year, so over the next little while, we've got some room to run up. So a good portion of it was not in the drinking business that they grew. It was actually due to snacks. Definitely snacks was very good. Cohen analyst notes that the company is seeing better convenience and gas trend, although a slow recovery on the on-premise business is likely. So nothing major there as far as that's concerned, but good to see. Let's look at this report here. We usually skip past this nonsense, you know what I'm saying? We skip past that because guess what? We love our charts. So overall reported net revenue growth, PepsiCo as a whole saw a 30% decrease as we saw there. Frito-Lay, North America, saw a 7% increase, and Quaker Foods actually saw a 23% increase. So very good as far as Quaker's concerned. You think about, obviously, stuff like oatmeal and granola bars, things of the like. And PepsiCo as a whole, really the beverage portion of it, saw a 7% decrease, which... Again, there were many reasons for it. There was certainly a can shortage for a while where they had to bottle more. They sell a lot more product in bottle. And you think about the fact that they lose all of their sales from restaurants for this quarter because restaurants were not doing sodas at all. They just, they weren't allowed to as far as these safety measures were concerned. So, and they were really shut down for the most part. So, not a big shocker in terms of that. So, nothing too bad. 7% is not bad. I mean, to only go down 7% as far as beverages with losing 100% of revenue from restaurants for the most part, pretty good. But that Quaker one's pretty good. You think about, what could have contributed. I will say in times of recession, there are some very generous individuals that go out there and they purchase large quantities of items like granola bars to feed those that are less privileged, that are in, low-income areas. So definitely that could be a portion of it, and that granola bars are, good forever, never going bad. So quality thing to get for those kind of meals on wheels type of organizations. So global snacks up 2%, global beverages down 8%, international snacks down 6%, international beverages down 13%. So beverages kind of struggled, but again, I mentioned that's mostly going to be related to restaurant, actually. So definitely think about restaurants when you think about that. So overall, by region, Latin America not looking good there. Brazil down 20%, Mexico down 16%. And Europe, though, Germany did find a 14% growth there in terms of revenue. Pretty nice. United Kingdom down 2%. For Africa, Middle East, and South Asia, the noteworthy one here would be South Africa showing a 12% decrease, not good. And Asia Pacific, Australia, and New Zealand, and China region, Australia was pretty well flat, and China actually showed a 24% increase. So again, that's going to be a mixture of pretty much of everything there as far as snacks, beverages, and the like. So mostly I would assume snacks took a big part of that. So what I would like to do now is let's take a peek at that balance sheet, because you got to think about it. With a company like this, you got to think about, the dividends they plan on paying out, and seeing what exactly that might mean for us. So press release, pretty much what we looked at there. Nothing too crazy as far as this is concerned. Gotta love these numbers, though. Pretty nice. Yeah, in fact, operating profits saw a 55% increase in terms of Quaker Foods, so really good to see that growth there. Really good. And, guidance is no longer applicable due to the magnitude of the pandemic. Not a shocker. So, really nothing crazy there. It's kind of what you expect. Every company's kind of releasing or really getting rid of their earnings estimates. So, let's look at this balance sheet. Right here, zoom in on this bad boy so everyone can see it. So they are giving me actually a 6 months ending balance sheet difference here. So you can see from a cash and cash equivalents perspective, they've got 8.9 billion compared to 5.5 billion. And you see this with every company. They've all been raising capital to get through the current pandemic environment. So therefore, they've been raising debt. So I'd like to see if that still runs true with this company. Overall current assets, total current assets of 23.1 billion versus 17.6 billion. Total assets in general of 89.5 billion versus 78.5 billion of 6 months ago. So good improvement there, but you typically will see the liabilities increase by just as much. So we'll look at that. Total current liabilities of 23.8 billion versus 20.4. Not much growth there. But when you look down here a little bit further, total liabilities in general of 76.9 versus 63.6 of a year ago. So again, you saw in assets grew by 11 billion, and guess what? The deficit or debt grew by a little bit over 13 billion. So overall, looking at that pretty well. I mean, I say it's relatively flush there. They raised a lot of long-term debt to really accommodate for, getting cash on hand right now, as every company really has. Balance sheet's not beautiful on this company. Again, as you talk about shareholder equity of $13 billion is pretty nice, but they're still relatively close numbers. Assets of 89 billion versus liabilities of 76 or nearly 77 billion. They definitely have enough to pay out their dividends still, no doubt, but some people might get concerned regarding that as the payout ratio increases a little bit this year because of the fact that, EPS is going to be down. So, but I don't think there's anything to be concerned. Pepsi is just a very consistent, good long-term holding to have in your portfolio. These levels, I think they're a little bit highly valued. Now, I think there's many reasons to think about it. P/E ratio only around 27 after today isn't insane, especially when you think about the fact they've got a fast-growing Frito-Lay business, which is massive for them. So they definitely warrant a higher P/E ratio than competition like Coca-Cola. because this is a company that has exposure into snacks with Quaker and Frito-Lay. But with that extra exposure can also mean extra room for decrease, but not so far this year, actually. They've seen good increase because of really people hoarding. They've been seeing good increases in snack buying, so good for them. And people are eating definitely less healthy because, well, it's a very stressful time for a lot of people. So typically people turn to unhealthy foods or bad habits with that. So unhealthy foods, smoking, drinking, stuff like that in times of, recession or really just any sort of crisis environment. So good for Pepsi. I don't think it's too overvalued at this point. It's a good value stock for the long term when you talk about dividend yield of around 3% at these levels. And it's going to be a consistent payer of that. So good thing to look at for there. So they also own Gatorade. But, beverages are just getting hit hard right now because they're having trouble producing. And once they get back to it, they'll be looking good. Especially next year, they're going to show some very good increases. So just be on the lookout for that. So I hope you enjoyed.